Oil hit $114 a barrel on Monday. At the same moment, the 10-year Treasury yield fell 9 basis points. Those two things should not happen at the same time, and the fact that they did tells you something important about where this market is headed. For the past month, the Iran war drove yields higher. The logic was simple. Oil up means inflation up, and inflation means the Fed has to hike. Bond vigilantes priced that in aggressively. Germany's 2-year yield jumped 64 basis points in a single month. The UK's 2-year gilt surged a full 100 basis points, the largest monthly move since the Liz Truss mini-budget crisis of September 2022, the event that nearly broke Britain's pension system and forced emergency Bank of England intervention. But on Monday, that logic flipped. The Strait of Hormuz is handling roughly 20 million barrels per day in normal conditions. It is now effectively closed. That is not a temporary price shock. It is a structural supply cut that grows more damaging every week it continues. Iraq has already hit maximum crude storage capacity, triggering a 70% collapse in production from its southern fields. Kuwait declared force majeure, and Ukrainian drone strikes over the weekend knocked out nearly 40% of Russia's oil export capacity, eliminating what had been the war's most likely pressure relief valve. The bond market looked at all of that and concluded, this shock is large enough to destroy demand. At that scale, inflation peaks fast and falls hard, not because prices come down, but because the economy contracts first. That conclusion puts Jerome Powell in an extraordinarily difficult position. Speaking at Harvard on Monday, he said the Fed's instinct is to look through supply shocks, that by the time a late hike takes effect, the oil spike is probably already over. That sounds reasonable in a normal energy shock. This is not a normal energy shock. The IEA's Fatih Birol warned last week that the current 11 million barrel per day deficit is worse than both 1970s oil shocks combined. Consumer sentiment fell 6% this month to its lowest since December. Short-run inflation expectations have jumped, but critically, long-run expectations, the 5 to 10-year horizon the Fed watches most closely, remain anchored. That is the thread Powell is holding. He is betting that if long-run expectations stay in check, he can avoid hiking into a weakening economy. Bank of America calculated that above the $80 to $100 oil range, inflation risk starts declining and converges with unemployment risk, because at that price level, demand destruction overwhelms the price signal. Brent is now at 114, and Brent is rising. Alcoa surged 11% after Iran targeted an aluminum plant, adding a commodity-specific shock layer on top of the energy disruption. The Fed is not facing an inflation problem or a recession problem. It is facing both simultaneously with the same instrument, and no rate decision resolves both at once.
The single variable that resolves this is the Strait of Hormuz. Everything else, the yield curve, the Fed's next move, the recession probability, is a downstream function of one question: does the blockade hold? If it holds, the demand destruction scenario accelerates. The 25-day tank top countdown in Gulf storage facilities means physical production cuts are already beginning. If that process runs its course, oil prices do not go to $200. They collapse because there is nowhere left to put the oil. That would end the inflation scare faster than any rate hike, but the economic damage arrives first. The weight of current evidence leans toward that L-shaped scenario, a price plateau that grinds demand down over months, not a V-shaped spike in recovery. That lean holds as long as the Hormuz closure continues and diplomatic signals remain theater. The reversal case requires something concrete: a verified ceasefire framework, a credible mechanism for reopening the strait, or a physical change in tanker traffic data. Trump claimed Monday that serious discussions are underway with what he called a new Iranian regime. Iran denied it within hours. Two benchmarks worth watching: whether the UK 2-year gilt yield breaks back below 4% in the next session, which would confirm the recession read is winning, and whether IEA emergency reserve releases are formally coordinated among G7 members after this week's ministerial meeting. If both happen, the bond market's Monday signal holds. If neither happens, and oil continues rising while yields also rise, the 1970s stagflation scenario Yardeni research is now pricing at 35% probability becomes the dominant frame, and that is the scenario central banks are least equipped to handle.